Thank you for joining us this afternoon. I know that we do have to make it an exciting session since we're in between drinks, between you and drinks. So as Colleen said, our session will be looking at changes in the investor base for emerging market debt and review sort of what has happened and where do we see things going. We have a great set of speakers assembled for you, and let me just briefly introduce them. You have the full bios on the flash drive that you will receive tomorrow. Allow me to introduce David Lubin first. He will review with you a very interesting presentation on emerging market as an asset class. David is currently Managing Director, Head of Emerging Market Economics at Citi, where he heads a team of some 30 economists in 15 locations globally. He has over 20 years' experience as an economist looking at emerging markets and joined Citi in 2006, having spent many years at HSBC. He was educated at Oxford. To his left is Alberto Fascinotti. Alberto is a managing director at Rock Creek, where he works on the emerging market portfolio. He began his career at Goldman Sachs and also worked at JP Morgan, Atlas, and Darby overseas. He holds an AB in economics from Harvard and a master's in foreign service from Georgetown. Lastly, but importantly, Luc Avaret. Luc is Assistant Director at the International Monetary Fund, where he is in charge of the Debt and Capital Markets Instrument Division. He joined the IMF in '92 and before that worked at the bank. He holds a PhD in International Economics from the Graduate Institute of Studies in Geneva. Now, I wanted to first very quickly set the stage for the discussion later on, providing some very brief background information on emerging market tradable debt. Now, as this slide indicates, the market capitalization of EM tradable debt has really grown significantly over the last 14 years and really reflecting a change in how emerging market sovereigns are meeting their net funding needs. The above chart captures tradable debt of 55 countries, and inclusion in that chart, the requirement was per capita income below $20,000. So if you looked at 2000, sovereign debt stood at 1.3 trillion. By the end of 2013, it had grown to 6.2. Important to note that a lot of this growth in tradable debt was driven by the growth in domestic local currency debt. Now, also interesting to note is that market is highly concentrated, with really the 10 issuers listed here accounting for 80% of the outstanding debt. And actually the first three make 50%, and China is the single largest issuer. At the end of 2013, there was 1.3 trillion outstanding for China alone. Also important to note that 6 of these 10 countries now have actually investment grade rating. So from a regional perspective, again, Asia is dominating the local currency piece. Hard currency piece is dominated by Latin America and followed by Europe. Now, in line with the increase in outstanding EM debt, that's where it becomes interesting. Foreign holdings of this debt have increased quite significantly. So this is just data that is based on research done at the IMF, where they looked at foreign holdings of 21 countries over time. And as you can see, or it might be slightly hard to see, for these 21 countries, foreigners held a total of 13% of the outstanding debt. But the average really masks quite a number of important differences. In 10 countries, foreigners held at least 20% of this debt. In 6 countries, they held 30%. And in one country, Peru, foreigners held 51%. Now, also interesting to note is the two of the three largest issuers, China and India, their foreign holdings are very small for obvious reasons. And what this table also indicates, if you look at Argentina, let me see what I can use, Argentina and Egypt, you see that it's not just an increase all across, but foreign holdings for these countries have actually gone down significantly. So the increase in outstanding debt and increase in foreign investor interest spurred the development of indices. And the table here just provides information on the main EM tradable debt indices offered by the various benchmark providers. The indices are quite important for investors because institutional investors typically use them to manage their exposure. And they either use them to manage their exposure passively or as a performance benchmark. So from a country's perspective, inclusion in the index becomes actually quite important for a number of reasons that we will discuss, I'm certain, with the panel as well. Now, investment banks do not typically track how much is invested versus the index, because that would give us a pretty easy idea as to what are our foreigners doing, or what type of foreigners do we have, what type of institutions. The only one is JP Morgan, and the number that we could lay our hands at, what currently across all the various indices, 554 billion or 9% of outstanding debt is actually managed against that, which is not a small number, obviously. So we wanted to understand the decomposition of the foreign investors. Obviously, the foreign investor group really includes a number of investors, such as institutional investors, central bank, retail investors, and banks. So, and understand how do they view emerging market local debt and debt overall over time. Pretty difficult to get hands-on information for institutional investors. Why do we care about institutional investors? They're pretty large. They manage a lot of assets. At the end of 22, according to the IMF, 16 countries, 16 advanced economies, institutional investors managed about 76 trillion. So any change that these investors make in their asset allocation is absolutely significant for a number of asset classes. So we've tried to put together, at the bank, we've tried to put together a better understanding of what various institutional investors are doing. Tricky. No, there is no systematic survey. We looked at 16, as one example, we looked at the 16 largest US public pension plans. And interestingly enough, 9 of them actually do have an explicit allocation to EM tradable debt. 8 of these have a strategic asset allocation target, i.e. this is a longer term allocation, and for one of them, that allocation is opportunistic and may therefore change. Now, this table has details, but I'm very happy to hand off and for David to do his presentation on EM as an asset class.
Thank you very much. Good afternoon, ladies and gentlemen. What I'm going to try and do is to ask you to look at emerging markets as an asset class as though you were the investor. You know, what does emerging markets look like as an asset class from an investor's point of view? What do they see? I don't have a full answer to that, but I've got a couple of observations to make. The first important observation, I think, is that China is becoming a less EM-friendly phenomenon. The growth of emerging markets over the last 15 years as a group of economies and the growth of emerging markets as an asset class since 2002 owes a lot to the connections with China, either through the intra-regional integration within Asia or through the creation of what I call the sort of China commodities complex, a particular form, a particular rate of Chinese GDP growth and a particular orientation of Chinese GDP growth, very investment-driven, commodity-intensive GDP growth, has helped to shape emerging markets since the early 2000s. And that's changing. That's changing partly because China is trying to manage down bubble risks in the credit market and the property market. One of the puzzles in 2014 in China has been that, on the one hand, at the beginning of the year, Chinese policymakers seemed very emphatic about a 7.5% growth target. And yet, all of the evidence that suggests that that 7.5% growth target will be missed has not elicited a dramatic, very aggressive stimulus response. And I think what's going on is, GDP growth is a means to an end. The end is job creation. China was able to generate 10.8 million jobs in the first 9 months of this year, and so it's able to relax about meeting its GDP growth targets, particularly because, as you can see, the evidence suggests that the rate of credit growth is under downward pressure, the composition of credit extension is becoming cleaner. Chinese policymakers are trying to manage away the risks associated with very rapid credit growth and a lot of dependence in recent years on the shadow banking system. One of the consequences of weaker Chinese income growth is weaker Chinese import growth. And clearly, one of the consequences of weaker Chinese import growth is lower level of commodities inflation globally. And that's what's illustrated on the left-hand slide. But there's something else going on in China, I think, which is that not only is lower level of income growth putting downward pressure on import growth, but the entire structure of the relationship between income growth and import growth is changing. And you can see that on the right-hand chart, which shows a decline, some evidence of a decline, in the marginal propensity to import. So for any level of income growth, China wants to import less. And I suspect that reflects a kind of rebalancing process that's taking place domestically within China. You can see, for example, in the last couple of years that services growth in China is more rapid than GDP growth, which seems to be some kind of evidence of a domestic rebalancing process in which eventually the ratio of consumer spending to GDP will rise, the ratio of investment spending to GDP will fall, but the import content of GDP is also declining. And so in a way, what's happening in China, this sort of moderate slowdown in the context of deflating property bubbles, deflating credit bubbles, works for China. But it works for China a lot better than it works for a bunch of countries whose dependence on China over the last 15 years has increased. The second overall kind of theme that I think is important, which follows very easily from the first, is the way in which life has changed for commodity exporters among emerging economies. If you look at the Fragile Five, Turkey, India, South Africa, Indonesia, Brazil, only 2 of the Fragile Five have actually been able to reduce their current account deficit since the first quarter of 2013. And those 2 are Turkey and India. Now, it's no coincidence that Turkey and India are the only manufacturing exporters among the Fragile Five. I'm not trying to argue that being a manufacturing exporter is the only thing that has allowed Turkey and India to shrink their current account deficits. India, as you probably know, was able to squeeze its import bill by reducing gold imports. Turkey's exports have been boosted by gold exports in the last few quarters. But the fact is, as you can see from the left-hand slide, the more commodity dependent you are these days, the worse your export growth is likely to have been. And one of the important sources of the explanation of why India and Turkey are the only countries to meaningfully reduce their current account deficits is that these are the only 2 countries that have enjoyed export growth in the last few quarters. Commodity exporting members of the Fragile Five have suffered the terms of trade shock that's generated by falling commodity prices. Actually, in general, I think it's possible to argue that a very important dividing line within emerging markets these days is precisely that dividing line between manufacturing exporters and commodity exporters. If you look, for example, at the left-hand slide just shows the way in which the incremental capital output ratio, the sort of measure of investment efficiency, which was quite similar for commodity exporters and for manufacturing exporters in the years before the Lehman crisis, has risen much more for commodity exporters since the Lehman crisis than it has for manufacturing exporters. Put it another way, the loss of investment efficiency has been much more dramatic among commodity exporters than it has among manufacturing exporters. And whether or not what I'm about to say is a connected point, I'm not sure, but you can see in the last few quarters at least that PMIs, some measure of economic dynamism, is suggesting that life is much better for manufacturing exporters among the emerging markets than it is for commodity exporters. So much so that I would argue that in 2013, the principal dividing line, the way portfolio managers made money in 2013 was to sell deficit countries and buy surplus countries. And that's because the tapering shock from May onwards threatened to suck capital out of emerging markets. And in any credit market, when risk aversion goes up, the borrowers that suffer the most are the borrowers with the biggest financing needs, and the current account deficit is some easy proxy for the financing needs of a sovereign. So just as in 2013, the main dividing line within emerging markets was between deficits and surpluses, I think it's becoming possible to argue that what's happening in 2014 is that the main dividing line is becoming between commodity exporters and manufacturing exporters. So, I'm just putting countries up here for the sake of illustration. It's intuitively kind of reasonable that the most vulnerable sovereigns in an environment where commodity prices are under downward pressure and where, we may be facing a tightening cycle in US monetary policy, the most vulnerable sovereigns are going to be commodity exporters with current account deficits, the bottom left quadrant. It's also kind of intuitive that the most resilient quadrant is the upper right, manufacturing exporters with current account surpluses. They're enjoying the terms of trade benefits of falling commodity prices, and they don't have to worry about financing needs because they've got current account surpluses. The tricky question is, how do you evaluate, or how do you think about the relative value between the intermediate quadrants? Is it better to be a Turkey or an India, you have a deficit, but you're a manufacturing exporter, or is it better to be a commodity exporter with a surplus? Russia or Venezuela or Nigeria. And I think what we're seeing is that the market investors are plumping kind of emphatically around the idea that the sort of second best quadrant after the top right is the bottom right. In other words, it's better to be a manufacturing exporter, albeit with a current account deficit, than it is to be a commodity exporter, albeit with a current account surplus. What I've said so far, to some extent, supports the point that there's a kind of straightforward transfer of resources from commodity exporters to net commodity importers when commodity prices fall. I don't think it's quite so simple as that. I think actually there's something asymmetric going on, such that when commodity prices fall, commodity exporters lose more than commodity importers gain. One way of illustrating that point is to think about Turkey. Turkey, were it not for the fact that Turkey has to import energy, Turkey would have a current account surplus, to give you some measure of Turkey's dependence on commodity imports. So you would think that when energy prices fall, the Turkish lira should strengthen, Turkish credit spreads should rally, and yet, historically, you'd never see that. There's no relationship that suggests that when oil prices go down, you should buy the Turkish lira or buy Turkish or receive Turkish credit spreads on the basis that the improvement in the current account deficit will cause the lira to rally and spreads to compress. And I suspect the reason for that has to do with the relationship between falling commodity prices and risk appetite. There seems to be some sense in which when commodity prices fall, particularly, of course, if it's a demand-led fall in commodity prices, when commodity prices fall, that has a kind of negative consequence for risk appetite. And so for a country like Turkey, there's a sense in which what it gains on the current account as energy prices fall, it kind of gives up on the capital account. So the net benefit is not quite symmetrical with the net cost to a country like Russia when commodity prices fall. So that link between commodity prices, falling commodity prices, and sort of shaky risk appetite is very important because, as you all know, I'm sure you've been discussing it already, there is an incredibly important cyclical aspect to capital flows to emerging markets, and that's been particularly true against the background of the sort of post-Lehman environment in which real US interest rates have been incredibly low. You know, we have at least 40 years of financial history that tells you that there are episodes when US interest rates are very sharply negative, that pushes capital towards emerging markets, and when monetary policy in the United States tightens, that sucks capital back. And so the cyclicality of capital flows shouldn't be underestimated. And then, you know, the question is, well, cyclicality with respect to what? I mean, the point that I've just been making is that the cyclicality is with respect to the US monetary policy cycle. But there's also, as we've seen, I think, in the last couple of years, a cyclicality with respect to growth. The chart on the right shows quarterly capital flows to emerging markets, 30 emerging economies, and you can see since 2011, it's inflows into emerging markets equities that have suffered almost quarter for quarter following the sort of deterioration in emerging markets growth that started in the first quarter of 2011. Fixed income flows have held up rather better because we've remained, in spite of the fact that emerging markets growth has been under downward pressure, we've remained in an environment where US monetary policy is generating kind of supportive yield differentials for flows into the fixed income asset class. What that means then is that if we are getting closer to the point of US monetary tightening, the question is whether we have to worry, to what extent we have to worry about the risk of capital flows being sucked from emerging markets as US monetary policy starts to tighten. There are a couple of arguments not to be too pessimistic. One has to do with home bias. I know you're all selling fixed income, but I just want to talk about equity markets in one respect, just because equity markets is one area where we can measure this point. And the point is that there seems to be some evidence of a long-term, almost structural decline in global home bias. What I've done on the left-hand chart is to use some methodology that was first put together by the Bank of England a couple of years ago to measure home bias in global equity markets. I won't bother going into the methodology, but what you can see is that for the developed members of the G20 and for emerging members of the G20, there seems to be evidence of a kind of sustained decline in equity market home bias. And that's good news. Another source of good news is that if we are moving into a tightening cycle in the United States, the threat that that creates to flows into your countries may to some extent be offset by the fact that any monetary tightening in the United States is going to be taking place against the background of kind of monetary policy divergence within the G3. So the question is, how much loosening in Japan or the Eurozone can offset the threat that might be created by monetary tightening in the United States? I don't know what the answer to that is. I mean, I think one point to bear in mind is what happened in April, May 2013. You know, in April 2013, when the BOJ announced very dramatic monetary easing policies, there was a surge of optimism about emerging markets. Spreads of the bonds that you issue against US Treasuries, in some cases in Mexico and South Africa, in some cases fell to all-time tights. And yet, 2 weeks later, we had, the kind of mother of all sell-offs because of the tapering shock. So that's still, or it creates a sense, in my mind at least, that the United States or US monetary policy still does play a kind of supersized role in shaping the risk appetite climate for global emerging markets at least. So although the decline in home bias and this point about monetary divergence, I think, help not to be too catastrophic about the outlook for capital flows, there's a reason to be a little nervous. A final couple of points. Another reason, a third reason, not to be catastrophically worried about capital outflows from EM when Fed funds rates go up is because of the change in the composition of capital flows to emerging markets over the last 20 years. So 20 years ago, 30 years ago, commercial banks were the dominant supplier of cross-border funding to emerging markets. Now institutional investors are your customers. Now, there's something importantly different between commercial banks and institutional investors as suppliers of cross-border funding, and that has to do with their funding characteristics. Commercial banks fund themselves at the front end of the curve, of the US curve, because they're managing deposits. Institutional investors, managing pension liabilities, for example, are more sensitive to points further along the curve, the US curve. And what that means is that maybe it was the 2013 shock that is most devastating to institutional investors, whereas the 2015 shock or the 2016 shock of rising Fed funds will have the effect of changing the behavior of commercial banks in managing their cross-border lending. That's good news for emerging markets because commercial banks are not, as I said, a big supplier of cross-border capital to emerging markets these days in the way they were in the 70s, 80s, and the early 90s. But just to leave you with one thought, there is one country to whom commercial banks have been lending huge quantities of cross-border dollars in the last 5 years, and that's China. You can see this is data from the BIS. China, between March 2009 and June 2014, borrowed $900 billion from international banks. 80% of that $900 billion, which you can see the maturity structures of international borrowing is on the right, 80% of China's borrowing from banks offshore had original maturities of less than 1 year. So the question is, why is a country with a current account surplus borrowing short-term dollars to the tune of about 10% of GDP? And I think the answer lies largely in the idea of speculative capital inflows. China has kind of presented a one-way bet in the currency since 2010, and B, the cost of funding in dollars has been unbelievably cheap. So that combination of cheap dollar funding costs and a one-way bet in the CNY means that China, to some extent, has been a kind of machine sucking in speculative capital inflows. As monetary policy tightens, it raises the question of whether, and by the way, now that we're in a world where the CNY is no longer clearly a one-way bet, thanks to PBOC efforts to end the one-way bet, the question is whether we are now in a transition period where the weight of capital coming in to China may reverse flow. Now, of course, that's not a balance of payments problem for China, but the question is whether China can lose 10% of GDP in the form of capital outflow at zero cost to GDP growth. And the concern that I have is that maybe one of the most reliable ways of thinking about the impact on emerging markets of rising Fed funds is that not so much the old version of that story, which was rising Fed funds just sucks capital out of emerging markets. My concern is that the new version of the story may be that rising Fed funds may be sucking capital out of China, creating a threat to Chinese growth, and bringing me back to the beginning of the presentation. Thank you very much.
Thanks very much, David, for a fascinating and thought-provoking presentation. Let's look at some of the facets. Luke, in your mind, we've seen initially some indications as to foreign ownership on local bonds. What do you think have effects been of foreign ownership on local bond markets? What are the major effects on those bond markets?
Thank you, Daniela, for asking me to be on the panel. It's I'm a bit distinct from the other two panelists. We also have clients, but our role is slightly different. So I wanted to emphasize that we've been very much in favor of supporting the development of these local currency bond markets, essentially because the benefits, I think, are pretty obvious. The best way to look at this is that, what does a local currency bond market look like without foreigners? What have we seen in emerging market space? Well, we basically have seen probably two possible inefficient corner solutions in such markets. One is where the sovereign needs so much resources, has no access to international capital, and therefore crowds out everybody else in the domestic market. And there's very little space for any efficient resource allocations. And the other side possibility is that essentially domestic investors have no alternative asset to invest in other than sovereign debt, and therefore that leads to essentially mispricing of risk. Both of them end up very close to a concept of excess liquidity, financial repression, where you basically see that people's savings are eroded and resources are not allocated efficiently. So I think that when foreigners enter in these markets, I think this changes, because foreigners look at these inefficiencies. They look at the fact that the yield curve is flat and other issues before they enter the market, and they basically start arbitraging some profits away and therefore improving the resource allocation, improving also the resource availability, the diversification possibilities. But I think to complement David's excellent overview of emerging markets, I want to overlay his presentation with another dimension, which is that not all emerging markets or local currency bond markets are at the same stage. And so what you see in terms of the investor base and how that evolves as markets develop is that initially you will get sort of marginal investors, the marginal investor base, the ones that are looking for high yields, more speculative type investors that go in first in these local currency bond markets. And at that time, they are basically chasing the excess yield that is in those economies. It doesn't immediately help the sovereign directly, because pricing may still be very expensive, but it's a start, and it starts basically building out the yield curve, because these foreigners tend to be interested in more longer term investments than the domestic banking system or other domestic investors. At this initial stage, you don't have too much volatility in your pricing, essentially because the market is just not liquid. And so some of the shocks that we have seen, the tapering episode and so on, have actually not affected countries that have, I would say, early stage development of local currency bond markets as much as they have affected others, because there was no liquidity. Now, the second sort of stage of development is where the sort of more real money investors come into the picture. And then you see a gradual decline and compression in spreads in the market, but also some increase in volatility, I would say, to normal and healthy levels, because you need that kind of stuff to allocate resources efficiently. And then we end up with cases where certain emerging markets are almost as a mature market in terms of their local currency development. And there you can see that all the global phenomena that David explained really feed through into the system fairly quickly. You know, if there is a decline in global risk aversion, you get large inflows of capital. If unconventional monetary policy provides liquidity to the rest of the world, you'll see large inflows, very strong yield compression. But the counterpart to that is that you will have more volatility in the pricing in those markets, because they will be subject to, you know, rapid in and outflows. And because the topic of this conference had to do with capital volatility and capital flows, we did a little exercise to just illustrate some of these things, you know, in terms of the share that foreigners hold of your domestic government debt market, you know, given that this is the focus of the audience. So we did the work for advanced economies because it's easier to get the right data together and larger samples. But what we see is that, you know, 1 percentage point increase in the share of foreigners that hold your domestic currency debt basically reduces the spread by up to 10 basis points. So you can see that, you know, in the context of capital flows during the crisis in Europe, which I use as a benchmark to do these simulations, you can see these strong effects. For example, during the period 2008-2012, there were some safe haven flows that went into the US, into Germany, and the result of that is that the spreads in those countries fell by around 50 basis points. But the opposite was true, of course, in countries with weaker fundamentals. You know, we saw Italy move the other way. Spain, at the peak of its problems, you know, had this outflow, which, you know, increased the spread by almost 150 basis points just because the share of foreigners disappeared from the system. So you can see and you can measure, you know, the impact of changes in the share of your debt held by foreigners on your spreads a little bit by this metric. And I think that for emerging markets, we haven't done all the work, but I think the elasticity may be even larger than what we have seen for advanced economies. So I guess the bottom line is that basically very beneficial to have the foreigners enter into your market, but at the same time, there are issues of volatility that you need to anticipate and you can anticipate.
Thanks very much, Luke. Alberto, we've heard David talk about search for yield as one of the reasons for foreign investors to move more into the EM debt space. What, in your experience, what have you seen with foreign institutional investors? What are they looking for in their EM debt allocation? And in your experience, do they have a longer-term view for this allocation, or do they do this really more on an opportunistic basis? And finally, how do they typically structure this allocation? I think that would be interesting for the audience to understand a little bit more about.
Sure, absolutely. Thanks, Daniela. So I guess the starting point from our perspective is we work on behalf of a number of U.S. institutional investors, primarily public pension plans and Fortune 500 corporate pension plans. On the public pension side, it really boils down to a search for yield. That's why you have seen flows into emerging market debt, both dollar-denominated and to some extent local, although not as much, and I'll talk about that in a second, over the last few years. But it has been opportunistic. And the one thing to consider is that on average, U.S. public pension plans are underfunded. And to meet both short and sort of long-term liabilities, their minimum threshold is an 8% net interest rate on an annual basis. So that's their starting point, and that's what they will be looking to achieve regardless of whether it's emerging markets or developed markets. I mean, that's sort of the goal that they're going after. When it comes to emerging market debt, it's not necessarily a permanent strategic asset allocation. It's still very tactical and still very opportunistic, which is why over the last 5 to 6 years, we've also seen a number of fund managers crop up that are sort of actively managing their exposures within EM to opportunistically go after the jurisdictions where they can capture even just short to medium yields that are sort of above that 8% threshold, and in some cases well above that, in order to make up for countries that perhaps are doing better and have seen spreads compress because they've done a better job of managing their economies. So it's not necessarily a permanent strategic asset allocation target within their overall portfolios. I will say that emerging market assets and investments in general have risen, both in debt and in equities. In the last sort of 18 to 24 months, there has been a lot of concern around sort of the strengthening dollar, right? And so from an investor's point of view, if you have dollar-based liabilities, you want to make sure that you're capturing that yield in dollars, and that a net decline in the local currency is not eroding some of that gain for you. So there's been some concern highlighted with the taper tantrum last year that going forward, a strengthening dollar might not be such a great thing for investments in local currency assets. That's a bit of a generalization, because I do think that you can still find some good opportunities on a single country basis, to sort of David's point on sort of the example you gave was on Turkey, which was sort of a drop in commodities doesn't necessarily mean a strengthening lira and things like that. But for example, this year, India has seen a strengthening currency on the back of, in part, lower commodity prices. But you've also seen a renewed interest in Indian both corporate and sovereign debt. The other point that I would say is that, to your point on to what extent Japanese easing and European easing can counterbalance tightening in the U.S., I think it'll have localized effects. I think the BOJ's stance today and going forward has had localized effects in the immediate area of Northern Asia, and will likely continue to have localized effects on countries which on paper are current account surplus countries and are net exporters, but have suffered because of a renewed competitiveness in Japan. So I think the level of counterbalance to U.S. tightening will be very localized, which is why I think a selective approach and a tactical approach to putting money to work in emerging market debt, if it wasn't important before, will become even more important in the future.
Well, thanks very much, Alberto. Luke, we heard about pension funds. Your experience, how do sovereign wealth funds or central banks look at EM debt, and what can you tell us about their exposure?
Yes, sovereign wealth fund community, of course, has increased rapidly over the past 10 years, and the amounts of assets that they are controlling right now are fairly large. I think we're approaching 7-8 trillion, although not all information is available on all these funds. I should start by saying that sovereign wealth funds are not a homogeneous group of investors. Some have different objectives than others, and as a result of that, naturally, it's reflected in the asset allocation strategies that they are pursuing. I think in our experience, there are essentially three groups of sovereign wealth funds. The first one is the type of stabilization funds that are actually guarding against volatile commodity prices and the impact on the macroeconomy of that. And these are your best friends because they are heavily invested in sovereign debt. The reason for that is that they need to be liquid, because they have to be able to call on these things when commodity prices move, which is very difficult to anticipate. Okay, there's a bit of a time lag because they can hedge and things like that, but still, they have almost 70% of their assets allocated to sovereign debt. Most of it is in advanced economies, but I'll give you some figures of what they are investing in emerging markets. Then there's another group of funds which are sort of generic savings funds or funds that are just simply investing excess foreign exchange reserves. You know, we have the cases like China and so on. And they have more of a focus on equities because they are looking more at the return. They don't need the liquidity as much as the other funds. So they're a bit more in for the long term. They still have a sizable share invested in sovereigns. So up 15 to 20% of their portfolio of these types of funds still is holding sovereign debt. And they're also holding quite a bit of cash. So, you know, they have buffers in the system in case shocks happen. And then there's a third set of sovereign wealth funds, which mimics very much the pension funds that Alberto has described, and they're not at all interested in sovereigns. They're just interested in yield. They're in equity. They're in credits. They're in, you know, high yield corporate sector, and in there for the very, very long term. So you can see that with these differences in structures, obviously different shocks in the system will affect the holdings of your debt. It's quite clear that with the commodity prices declining, you will have two very important effects happening. On the one hand, inflows into sovereign wealth funds are going to diminish, and therefore the trend increase in their holdings across their portfolio is likely to diminish. So you will see weaker demand from that side. And then in some cases, there may even have to be sell-offs of sovereign holdings because they have to meet their stability objectives from declining commodity prices in the system. The other funds, of course, the pension funds and excess reserve management funds are not going to have such a dramatic effect on your holdings. Central banks are also your best friends. Just ask the Treasury and or any Japanese, the Japanese Ministry of Finance. There have been, of course, massive purchases of sovereign debt by central banks, and it has not just been the case for these unconventional monetary policy experiments, but also because central bank reserves tend to be invested in sovereign debt abroad. Just a few numbers on this here. The increase in holdings of emerging market sovereign debt by central banks has been quite important over the last 2 years. It started from virtually zero. There were almost no holdings of emerging debt back in 2011, and we now are estimating already 100 billion has been invested in terms of emerging market debt. The proportions in some cases are fairly long, very, very high. I mean, I'm just going to give you some examples here. That there are some countries where foreign central banks hold more than 30% of the sovereign debt that was issued by the country. And those cases are, for example, Indonesia, Latvia, Romania. They have very high central bank central banks have very high appetite for them. But there are other countries like Peru, Hungary, Bulgaria, where the share is still between 20 and 30%, and those are quite sizable, shares of foreign debt. Of course, when central banks need to use their reserves, they will sell off first in the most liquid markets, and therefore, I think they will provide some protection for the emerging market holders. Thanks.
Thanks very much, Luke. Before we ask the audience, let me ask David one question. You mentioned, we talked a little bit about increase in foreign holdings of EM debt, and Luke mentioned the effects on rate volatility. In your view, what vulnerability does foreign ownership create, if at all, for EM countries? And what is that particularly pronounced for those where foreign ownership is substantial. And what are the specific sources of vulnerability? And in your mind, how can they be best managed from an emerging market perspective?
Yes, I mean, I think, there are lots of sources of vulnerability. One is kind of macro vulnerability, the kind of vulnerability I was talking about earlier. There's another vulnerability that relates to kind of positioning, which I think was implicit in your question. And the fascinating example in this context is Mexico. In the first half of 2013, Mexico was just about perfect. Very disciplined monetary policy, very disciplined fiscal policy, no notable external imbalances, current account deficit small, well-financed. Peña Nieto starting to deliver a structural reform process, everything fantastic. In April 2013, the peso was 10, it's now 14. So why is it that a country with, on the face of it, strong fundamentals should have suffered so much in the last 18 months? And in a way, I think the sort of paradoxical answer is that Mexico suffered because everybody loved it. When investors suffer risk aversion, they sell what they fear, i.e. weak macro fundamentals, and they sell what they own. And Mexico suffered as a result of that. And I think...
Sorry, Dave. I'd like to add to that Mexico suffered also in part because it was liquid.
Yes.
It didn't have capital controls in place at the time, like other countries. So in some sense, it did do everything right. It was liquid, and it was sort of the one source that people could sort of pull their money from.
Yeah, no, fair point. I would just say that the liquidity of the market is in a way part of the argument that its fundamentals are strong. Exactly. So you get these kind of paradoxical effects. And I think, you mentioned, the threat created by the stronger dollar, and I think that's a very important, in a way, the additional source of vulnerability. It's almost like there's a kind of life cycle of flows into emerging markets fixed income. For example, in the last few months, from the very beginning of September 2011 until December 2011, there was a big sell-off in emerging markets FX. Currencies depreciated, volatility increased very sharply, so there's capital outflow from emerging markets funds. When inflows started to return in the early part of 2012, the bulk of the inflows in the early months, well, actually, for the first, I would say, at least 2 quarters of 2012, the bulk of the inflows into emerging markets were into dollar fixed income. So, responding to declining home bias, the asset allocator of a US fund might say, oh yeah, I want some of that emerging market stuff, but don't give me any of those scary currencies. Give me something, nice dollar-based that, I kind of understand. Interestingly, the same thing has been happening in 2014. So we had a period of tremendous turmoil in emerging market FX markets in the second half of 2013. The bulk of, all of the inflows into emerging markets in sort of net during the course of this year have been into hard currency. I mean, year to date, local currency funds have been seeing outflows. So, and it's only, I think, just about now that, we're at the point in the life cycle of the flows where where kind of investors new to the emerging markets asset class might have forgotten about the currency turmoil of 2013 and maybe thinking about introducing some currency risk into their portfolios once again. The problem, though, is that instinct, the beginning of a flow is kind of made complicated by the strength of the dollar, which is kind of, causing...
But David, from an investor's perspective, you're essentially making you're taking on 2 risks. One is currency risk, the other one is the rate risk. So it is actually, from a US-based, European-based investor, in the end, liabilities are in a different currency.
Yes.
So you have to take that into account. There are questions as to what can markets, what can emerging markets do in order to help these investors to differentiate and actually separate those decisions, i.e., to what extent can they hedge, to what extent do they have sophisticated synthetic markets that allow investors to express a view on rates. So I do think there are, I mean, from an investor's point of view, I think if you go into local currency, you have to make two sets of decisions. One is the currency, the other one is the rate view.
Yes, the problem is that almost by definition, those two risks are difficult to separate out. I mean, there are countries where you have access to hedging instruments that, in which you can hedge the FX risk and still leave yourself with some premium, but that's more unusual than not.
But all I'm trying to say, it gets tricky. I mean, currency is an important part of the decision. If EM currency declines, that just becomes very much part of the equation.
And I think in a way that's one of the sort of doubts that I have about the coherence of emerging markets as an asset class.
Although I would argue that for a European-based investor, a local currency EM debt might look a little bit more attractive than for a U.S.-based investor, because I don't think anybody in this room is expecting the euro to appreciate anytime soon, in sort of the next sort of 12 to 15 months. So I would argue that for a U.S.-based investor, part of the reason that you have seen, to some extent, flows maybe go back into EM debt, it's been predominantly in U.S.-denominated debt.
Fair. David, in terms of what can countries do in terms of managing vulnerabilities, anything that countries can do?
Managing the macro vulnerability.
Managing macro vulnerability, anything else they can do in order to...
I think it's interesting. I think there is... I mean, none of what I said in my presentation had anything to do with the quality of economic policy. And I think that's becoming a much more important idea. Mexico, to go back to Mexico, one of the reasons why investors kind of fell in love with Mexico in 2012 and 2013, because there seemed to be a kind of positive shock to the quality of economic policy under Peña Nieto. Same thing is happening in India under Modi. What's interesting is that it's only in the last year or two, I mean, okay, the quality of economic policy has always been an important thing, but I think what happened after the Lehman crisis, after the crises of the 1980s and the 1990s, the principal diagnosis of what's wrong with emerging markets was the idea that emerging markets' vulnerability consisted in weak sovereign balance sheets. It was the lack of FX reserves. It was having large public debt burdens. That's what constituted vulnerability. And so, in a way, the most visible, the most important effort that policymakers have made in emerging markets over the last, since the early 2000s, is to strengthen sovereign balance sheets. And that strengthening of sovereign balance sheets has brought rewards. I mean, if you look at the average sovereign rating in emerging markets, the average sovereign rating has gone up a couple notches since 2004, when the evidence of that balance sheet improvements first started to become visible. And I think what's happened is that focus on the health of sovereign balance sheets almost crowded out structural reforms that aim to improve the investment climate and support animal spirits. And I think, in a way, countries were able to ignore that aspect of economic policy because international conditions were so favorable. You had, rapidly growing China, you had rapidly growing advanced economies, full of credit availability. Now that those things are increasingly unavailable to developing countries, I think the quality of economic policy, the kinds of measures that it takes to support the investment climate and to lift private sector animal spirits, those kinds of policies are becoming more important than they were in the 2000s.
Thank you. So let me see whether there are some questions from the audience. Yes, please.
Is coming to the question of these local currency debts, do you think enhanced securitization of the local currency debt market in the form of special purpose vehicles or whatever, can provide increased mitigation of the risk for the investors, especially the foreign investors, in the context of the emerging economies. Whether securitization as a policy tool would help mitigate the risk. That is my question.
Luke, do you want to?
Yeah, I just wanted to, we've done some work. Of course, it's part of our job at the IMF to focus on vulnerabilities. And while I'm don't want to comment too much on the specific securitization that you have in mind, I think that there is evidence that countries that have put in place what we call these days macroprudential policies at the time of capital inflows have been able to have more resilience to the volatility in the system. Of course, there's been a big debate on whether or not these are good for efficiency, but of course the financial stability elements that are associated with these large inflows and are now no longer going to the sovereign, as David mentioned, but are going in through the corporates and through the households to cause possible bubbles, I think is an important phenomena that requires new tools. And these, I think we are encouraging development of these kind of tools. We've looked at countries that have put in place some sand in the wheels of the capital inflows, and they seem to have done fairly better in avoiding excesses in their domestic economy.
Anybody like to add?
Yeah, I mean, I would argue that one is how you securitize the actual structure of that product, and second is how liquid, right? How easy is it for a foreign investor to, one, go in, more importantly, come out? Because we have seen in recent years certain countries, certain jurisdictions impose various forms of capital controls, paradoxically actually for sending money in, not so much sending money out. But those types of things are not something that the institutional marketplace, at least here in the US, very much appreciates, and it's just another reason for them to sort of say, maybe I can capture that yield somewhere else.
Any other question from the audience? Well, I'll let you think about it a little bit more. We have some more questions up here. So we talked about, all of you sort of mentioned what happens if U.S. yields normalize, and we had, you referred to the temper tantrum. But Alberto, what will your investor base do? Do you see any change in the allocation to EM debt? What's your view? What will happen?
I think over time, so the long-term view is still sort of the long-term secular views that eventually you will see a convergence of rates and spreads between developed and emerging markets, but we're probably pretty far off from that point. In the short term, as I said, I think investors, at least here, will remain fairly tactical and fairly opportunistic, and they will, in emerging markets specifically, are looking to move away from passive ways or instruments to pursue that type of yield, and would rather look for structures and or debt managers that can be very selective and overweight certain countries with better attractive yields, better valuations, and underweight others that maybe are not as attractive. So there is a shift towards more opportunistic, tactical, active management within EM debt, which will become, I think, even more important once rates in the U.S. do normalize. On that last point, I do want to say there's a lot of talk about rates in the U.S. normalizing. I think that's at least 2 years out, at least, at this point. I mean, we haven't even begun, right? There's just a lot of talk, and you could argue whether or not how much of that is actually priced into the market. But I think the normalization of rates in the U.S. is going to be very slow, very methodical, and in the interim, the market is going to be very volatile, which on the one hand, to your point, is a positive, because it does create a little bit of churn, and it does create a bit more attention for the asset class. On the other hand, it forces investors here to be very tactical and not necessarily put large percentages of their portfolios in the asset class as a long-term option. So there's going to be a lot of differentiation between different markets, between different countries, and it's going to be, in my view, very tactical over the next few years.
Look, what do you see central banks doing, or how will sovereign wealth funds react?
Yes, I think that both of these types of investors have a bit of a longer horizon with also more of a sort of public good perspective than private investors. But central banks will definitely be tempted to also increase the yield on their reserves because it's been very low for a long time. And if it is the case that the US dollar continues its appreciation and the interest rates go with it, I'm sure that there will be a shift in the portfolio of central banks in that direction. So it doesn't always only have to be the fact that it's the interest rate, because they also take into account what happens with the strength of the dollar. Sovereign wealth funds, on the other hand, most of them are very contrarian animals, because they have a very long-term horizon. Their strategies tend to be based on mean reversion, so what over a very long time horizon. So what they will tend to do is they will look for asset classes where the rates of returns are, deviating from their long-term, however we can, guess what that is, and go into those groups. And that may well be counterbalancing some of the other investor classes that are more pro-cyclical in the system.
Allow me to ask the audience, any more questions? All right, so all of you mentioned that EM is not one monolithic entity. You talked about, David, about EM is truly an asset class. So in your view, to what extent do investors differentiate between emerging markets? And what are in the end the driving factors for this decision? Macro, liquidity, hedging instrument, capital controls, what in your mind are important decision drivers for thinking through exposure to EM debt? Do you want to take that first, David?
I think all of the things that you mentioned are important. The thing, though, is that the relative the scope for investors to discriminate across those variables increases with stability. So if investors have absolute certainty, or at least a high degree of confidence, that, say, the US monetary policy environment is stable, commodity prices are stable, China is stable, that the more that investors feel they understand the world and that the world is predictable, the more they're willing to make those differentiations across markets. But those differentiations become much less important when you get a kind of external shock coming from expected changes in US monetary policy, from changes in commodity prices, etc., or changes in growth. And so the willingness to differentiate is a kind of function of stability in the sort of external environment that shapes emerging markets. I think one of the things that may become important over the next couple of years, I mean, I take your point that it may not be next year that we have US monetary tightening, it may be 2016, and it may be not the kind of dramatic threat that it has been in the past sometimes, but it's the kind of combination, I guess, that I was trying to get at in my presentation, of US monetary tightening and a change in some of the things that have held emerging markets together. Rising commodity prices, strong growth in China, for example. It's that trio of factors that are sort of breaking down that I think is going to cause some fragmentation in emerging markets. And a couple of other points. And this is kind of speculative, but I think there might be something to it. I wonder if, and I'd be very interested in Luke's view of this, given your expertise on sovereign wealth funds, I wonder whether one of the things that has supported emerging markets as an asset class in the last few years is the existence of a kind of virtuous circle with respect to the relationship between the US yield curve and the behavior of central banks. So, very simply, you have low US interest rates, capital gets pushed to emerging market central banks accumulate foreign exchange reserves as a result of those capital inflows and the current account surpluses that they've had in the last 10 years. They buy US treasuries, that puts downward pressure on US treasury yields, and so the virtuous circle, is kind of kicked off again. I wonder whether the combination of falling oil prices, to the extent that it's permanent, the effect that that might have on the deployment of petrodollars throughout the international financial system, the possible consequences of capital outflow from China, as I discussed, and the extent to which that might put downward pressure on foreign exchange reserves in China. I wonder whether, over the next few years, what we may end up with more likely is a kind of vicious circle, where, capital is flowing out of emerging markets as central banks accommodate capital outflows. There's upward pressure on US Treasury yields. That creates a bit of nervousness about risk appetite towards emerging markets, and so there's capital outflows. And what was a virtuous circle after 2002 until kind of now may, over the next 10 years, be something more like a vicious circle. It's, again, not something to lose sleep about now, but I think it's worth considering. And one other point, sorry, just quickly, is we're now in territory where countries like Brazil, South Africa, Turkey, Russia, who together you're getting towards 30% of the index with those 4 countries. I don't want to be rude about any particular country, but you've got to acknowledge there's a risk of a sub-investment grade rating for all of these countries over the next couple of years. I know Brazil is a net external creditor in foreign exchange. I know Russia is a net external creditor in foreign exchange. It's difficult on the face of it for a rating agency to want to put a net creditor as sub-investment grade. There's something counterintuitive about that. But of course, the rating agencies are trying to create analysis around the kind of prospects for the balance sheet, not the balance sheet as it stands today. And I think that downgrade risks over the next couple of years for some of the big sovereigns that shape. I think it's fair to say that what happens to the collective sovereign rating of those countries I mentioned, Brazil, Russia, Turkey, and South Africa, that will shape risk appetite towards emerging markets to some extent, because they're such an important part of the indices. And so, and of course, for Brazil, for South Africa, for Russia, 3 countries that are net commodity exporters that are have been very vulnerable to the decline in commodity prices over the last couple of years. I think again, going back to the point that I was trying to make earlier about this new emphasis or new importance on the quality of policy making, I think that's going to be important.
Alberto, do you want to add to that?
No, I mean, I agree with David's points. I go back to some of the developments that we've seen in the marketplace over the last few years, which is you're starting to see disparities between different countries, both in emerging markets and in frontier markets. So it's from our perspective, it's not a homogeneous asset class. There are going to be selective opportunities to go long as well as short, particular EM debt, both in dollar and in local currency terms, to the extent that it's actually possible. So that, to me and to us, speaks to an opportunity to be again selective, to be active, and to construct portfolios which are not passive, which are not simply reproducing or tracking a particular benchmark, but rather maximizing the potential for yield and return by creating specific overweights and underweights at a country basis. On sort of the weak 5 or the fragile 5, I agree with David on Russia and South Africa. I think on Brazil, while it is a net exporter of commodities, it's a more diversified economy than Russia and South Africa. It has a domestic GDP which has a pretty significant consumer and domestic sector. It's also a much bigger country from a population perspective than either Russia or South Africa. So in Brazil, I think it's yes, commodity related, but also policy related. I think where the second term of the Dilma administration goes from here, everybody's watching. Everybody will be looking to see what the implications of any changes in policies will be, because it could, I think, compared certainly to some of the other real sort of commodity-dependent countries, they might have a few options that they could pursue, but it's entirely sort of a set of choices that they would have to make.
If there's any question from the audience, then Luc, let me ask you. To what extent do you think there is herding behavior? I mean, sort of asking the same question that I just asked, it slightly differently around. And while I appreciate Alberto's view on ability of managers to pick and choose, the question is, in the end, I know at least institutional investors are benchmark driven. So to what extent do we see herding behavior, and what in the end drives that? And how can, again, is there a way for markets to at least create greater resistance to that, greater insulation?
Well, I think that procyclicality, or sort of herding behavior of investors or certain types of investors, is a well-known phenomenon. What is it attributable to? Well, I think that in a nutshell, I think that investing is costly. You have information costs, and you're subject to mandates because it's a contractual world. We write contracts. So if you put those two things together, obviously people try to economize on the information costs, and therefore they will look for aggregate ratings. But a rating in, let's say, a double B can be a high double B or a low double B. It's not exactly the same. Some are subject to, downgrading or upgrading, and investors may not do their own, may not incur the cost to do their own thing. This is obviously being exacerbated by, the passive vehicles out there like the ETFs, where basically the retailers, you and me, start deciding where we want to invest. And the experience is that we tend to be a bit skittish. We're usually late in the cycle, and fairly quickly to run if something happens, and then we sort of all run together. So I think that if you put that together, there's definitely some evidence of this kind of behavior. What do you do about this? Well, I think as debt managers, putting out information. I mean, I'm looking here mostly at the sovereign space, which is in the audience. It's not so difficult, I think, to put more information out and be more transparent about public policy, the state of the sovereign's balance sheet, all these other things, and also about the institutional arrangements under which you operate, your reserve buffers, those kind of things matter a lot, a bit like, Mexico being a case which is very transparent and can help investors differentiate when it's necessary.
Alberto, David, any final thoughts on that? Well, if there is no more question from the audience, I will thank you very much, David, Alberto, and Luc, for a very interesting discussion and for a great view of the subject. Thank you very much. And now you're free to have drinks. Thanks for your participation.